All right, welcome all to day four. So, in day one, we went through some exam tips and tricks and an overview of the exam and the CBE platform and everything. Then, in day two, we discussed certain topics like the NPV and IRR. Day three, we did uh, type C questions, okay, from the three focal areas that we discussed earlier. And today, day four, we'll be doing 100 marks mock paper. Okay, so without further ado, let's start. So, question number one says in relation, so this is section A, 15 questions, 30 marks. Okay, so 2 marks each. In relation to hedging interest rate risk, which of the following statements is correct? Smoothing is where liability and assets with a common interest rates are combined. That is incorrect. Now, the way I would suggest is when I read a question, take a pause, go through the solution, as in the options, answer it yourself, then resume the video so that you know whether you got it right or wrong. Wherever possible, I'll give you an explanation why it's incorrect or why is it correct. Now, for example, this one, smoothing. Now, smoothing has to do with, say, for example, the central bank needs to hike interest rates. Say it needs to hike interest rates by 1%. It won't all of a sudden just hike interest rate by 1%. It will be done in a very smooth manner. So it will be done like 25 bips every quarter. So over a 1 year period, you would get a 1% hike in interest rate. So it's done slowly and steadily, very smoothly. That's why it's called smoothing. An interest rate future contract grants the buyer the right but not an obligation. That's incorrect again. Futures give an obligation, not a right. Forward exchange contracts are exchange traded funds. Again, incorrect. It's futures which are exchange traded, not forwards. Forwards are OTM contracts. And that leaves us with D, which should be the correct answer. Let's read it. Interest rate options allow the buyer to take advantage of favorable interest rate movements, which is absolutely correct. Options give you the right to exercise. So only when if there is a favorable movement, you will say that I do not wish to exercise my right and enjoy that favorable move. And during adverse movement, you will exercise it to protect yourself. Right? Question number two. M company is evaluating an investment project, uh, which so 10% cost of capital. Initial investment is 450,000. Year 1 to year 5 cash flows are given. NPV of this particular project is 55. Therefore, it's acceptable. Now, in year 5, there is an asterisk which says that it includes 20,000 residual value. Well, so what? As in, um, uh, it's just to confuse us. So it's fine because we would any which ways an asset's residual value would be included. Um, like it's like scrap, right? So what is the discounted payback period during this investment? Now they want a discounted payback period. So payback period is when the project break even. So that's exactly zero cash flow. So let's quickly, just plot one. So here we have 0 plus 1, 2, 3, 4, and 5 years. Then we need our cash flows. Our cash flows. Now there is initially an outflow. So I'll put it as negative. Okay, then we have inflows. So here 1, 2, 3, 4, and 5. Right? Then discounting factor at a rate of 10%. Now, in the exam for section A, you are not given access to a spreadsheet. However, you have a discounting factor table. So, from in an exam, you could just take help of the factor table and find these values and multiply the cash flows with these factors. But here, since I don't want to open many tabs, I'll just quickly calculate it. Raised to n. So n being this. So in the now year 1 is already in present value. So That's why even if you see the discounting factor is 1 because it's already present value, but we don't write it. Okay, then discounted cash flows. So this is already in present value terms, this into this. And I can just copy paste the formula. Just check it if it's proper. Yes, works. And then we have our cumulative discounted cash flow. So in year 0, it's an outflow. Then in year 1, we get an inflow. So on a net basis, it's an outflow of 332 and so on and so forth. Let's just check if the calculation is done right. Yes, it seems proper. So now we realize that in year 4, we are last negative, and then in year 5, we turn positive. But payback is the break-even point. So we need, when do we turn 0? So it's after the 4th year. Now let's see the options. Okay, so we have 2 options of 4 years. Sometimes if there is only one, you need not even spend further time. You can just select that and proceed. But however, in this case, there are 2 options. So we can say that, so in the 5th year, how much is the cash flow? The cash flow is 93. So in one entire year, we are earning $93. Okay, let me just put this a little up. Yeah, so in one entire year, we are earning $93. This is basically a year. And this is the discounted cash flow that we are earning. Just leave a gap. Yeah. Okay. And the question is, in how many years do we earn exactly $38? Why 38? Because that is what we require to turn this negative 38 into 0. All right. So simple cross multiplication. That is 0.407, or we round it up to 0.41. Okay. So actually, wait a minute. This will be minus 20. Okay. Sorry. It's residual value. It's not a cash flow. It's not your scrap value. It's just residual value, which is left. Okay. It's not sold or anything. This includes, so 150 includes this. So we should be excluding it. Okay, so the answer is actually 4.47. I purposefully made that mistake because a lot of you will include 150. Okay, as in they have given us 20 and you will think that it's scrap and you will include it. But remember, it is not scrap, your correct answer. So if you would have done 150, you'd get 4.41. You would have marked this, which would be the incorrect answer, and you would have wasted time also doing all these calculations. Okay. So remember, it's residual value, which is not a relevant cash flow. Okay. And this will be your final answer. So keep that in mind. All right. You should, how can residual value be scrap? Otherwise, they will say scrap. But a lot of people think that it's scrap and they would say that it's a relevant cash flow. So yeah, 150 inflow already includes it. So no need to do any adjustment. Okay. But anyway, I hope this is clear. Now, question number 3. The following statement relate to market efficiency. So an analysis taking a chartist approach in an efficient market would not be able to make any statistically significant gains. And statement number 2 is, if a market is efficient of any type, share prices are said to follow a random walk. Are the statement true or false? Okay. So statement number 1, is it true or false? Now, a chartist, okay, or anyone in fact in an efficient market cannot make any significant gains, because we say that in an efficient market all the information is already factored in. In fact, if you are a chartist or it is said that technical analysis or chartism works when the market efficiencies are weak. Okay, so this is exact opposite. So basically, we won't be able to make any gains. So that's a true statement. If a market is efficient, yes, prices follow a random walk because, as we said, prices are already factored in. It's very difficult to beat the market on a consistent basis in an efficient market. Okay, so yeah, everything is factored in and it is random. So you cannot beat the markets. Okay, consistently beat the market rather. So in this particular case, both statements are correct. Statement number 4, what is the likely impact on an economy of a policy of high interest rates? Okay. Now, what is the likely impact? So when the interest rates are high, what happens? An appreciation of the currency's exchange rate and an increase in consumer expenditure. Okay, likely impact of high interest rates. So if you see this, an appreciation in currencies exchange rate. So now when we studied in IRPT, okay, so when the exchange rate goes when the interest rate goes high of our economy, what's going to happen is a lot of foreign funds are going to invest in our country. Okay, so that is going to increase the demand of our currency. Therefore, our currency will appreciate. All right, so statement 1 is the likely impact. Now, statement 2, an increase in consumer expenditure. Well, see, when our interest rates going up, when already there is inflation, as in prices are already high, to discourage it, interest rates go up. Okay, so this is already, it's not like an impact of it, right? So the correct answer will be only statement 1 is, so A. Okay, moving on. Question number 5. Which of the following statement concerning shareholders' wealth is correct? Wealth of the shareholder is increased by dividends received and capital gains on the share owned. Share prices may increase irrespective of the decisions of the manager. A rise in earnings per share will cause, okay, let's take one statement at a time. Okay, so a rise in earnings per share will cause an increase in shareholders' wealth. Now, EPS has to do with profit maximization and not shareholders' wealth maximization. EPS is an accounting figure. Okay, EPS is nothing but profit after tax divided by number of shareholders. So it's profit maximization, and we have studied that profit maximization does not necessarily lead to shareholders' wealth maximization. Okay, so this statement is incorrect. Statement number 2, share prices may increase irrespective of decisions of the manager, which is correct because see, share prices are impacted by various factors. Okay, so whatever the managers decide, it is on market perception whether this decision is a good one or a poor one, and accordingly the share prices will move. So this is correct. Okay, wealth of shareholder is increased by dividends received and capital gains on shareholder. This is also true. Think of it. You are a shareholder. How do you make money? You make money when the share prices go up. That is capital gains. So when the share prices go up, you sell it, you have to pay capital gains. Okay. Or you enjoy capital gains. And the second one is when you receive money, that is in form of dividends. So these are the two ways in which the shareholders' wealth increases. So in this case, again, the correct answer is A. That is both statement 1 and 2 are correct. Moving on. So in a not-for-profit business and a state-run entities, a value of money audit, okay, VFM, if you remember, can be used to measure performance. It covers three key areas: economy, efficiency, and effectiveness. Which of the following could be used to describe effectiveness in this context? Okay, so economy had to do with uh, minimum cost, so the cheapness. Okay. Efficiency had to do minimum input, maximum output. And effectiveness, let's see. So avoid wastage of inputs. Now that is economy. Achieving agreed targets, that is effectiveness. Achieving a given level of profit, obtaining suitable quality inputs at the lowest price, that can be maybe efficiency. All right. So for us, it's this effectiveness we have been asked. So B. Right. Moving on. Which of the following statements about money markets instruments are true? A company can use the money market to manage exposure to foreign currency risk. Well, we had studied one of the way that yes, uh, money market, as in money market, you can use the money market. Basically, you are investing or depositing in one country and you are borrowing in another country. Okay, that's how you can manage your foreign currency risk. One of the ways. Options are interest bearing instruments where the investor receives face value plus interest at maturity. Not sure what they are talking about. And also, it's not an obligation. We always have a right and an option. Certificates of deposits are non negotiable. Okay, so, well, they are negotiable because they are traded. Okay, so when in the markets, you can negotiate a rate. Now, so options are interest bearing instruments where investors receives face value plus interest at maturity, which is again incorrect. Okay, so statement 1 seems the only one to be right. So I guess it's section as in it's option A. All right, only statement 1 is correct. Moving on, which of the following statements about gearing are true? Financial gearing refers to variability of returns caused by debt interest, and therefore, what financial gearing refers to the variability of returns caused by debt interest, and therefore, financial risk is often measured by the debt to equity ratio. And operation gearing refers to variability of returns caused by fixed cost of the business operation, and therefore business risk is best measured by operating profits to sales. So both statements are true, both statements are false. Statement 1 is true, statement 2 is false, statement 2 is true, statement 1 is false. So what do you think? Take a pause. Okay, again, every question, read it. Okay, take a pause and then answer it. So in this particular case, let's read again together. So let me just, yeah. So financial gearing refers to, so what is financial gearing? The component of debt in the overall cost of equity. What is operating gearing? The component of fixed cost in overall cost. Okay, so that is fixed plus variable. So fixed divided by fixed plus variable, and debt would be debt divided by capital employed. Okay, or again you can write debt to equity, whatever. So there are different ways, but this is the basic understanding that how much is the fixed cost involved. So in this case, fixed interest cost, and in this case, it's the fixed cost. So financial gearing refers to variability of returns caused by debt interest, and therefore financial risk is often managed by the debt to equity ratio. Some seems correct. Okay. Operational gearing refers to the variability of returns by the fixed cost of the business operation, and therefore the business risk is best measured by operating profits to sales, which is incorrect. Okay, because operating profits would have both variables as well as fixed. Okay, so this seems correct. So, yeah, section as in option number C is correct. All right. So let's just mark that section number, or sorry, option number C. Statement 1 is true, statement 2 is false. Okay. Now, next question. SK sells bathroom fittings throughout the country in which it operates. In order to obtain the best price, it has decided to purchase all its annual demand of 10,000 showers. So good anyways, we would need annual demand. From the single supplier, RR has offered to provide the required number of SHAs each year under an exclusive long-term contract. Demand for SHA unit is at a constant rate all year. The cost of SK of holding one SHA unit in the inventory for 1 year is $4 plus 3% of the purchase price. RR is located, just a moment. Yeah. Wait, let me just. Yeah. RR is located only a few miles from SK's main showroom. It has offered to supply each SHA unit at $400. So that's the purchase price and a transportation cost of $200 per delivery. That's the ordering cost. It has guaranteed such a regular and prompt delivery service that SK believes it will not be necessary to hold any safety inventory or buffer inventory if it uses RR as its supplier. What is the optimal order size, assuming that RR is chosen as the sole supplier of SHA units for SK company? Okay. Now, optimal order size has to do with EOQ, economic order size, or sorry, economic order quantity, EOQ. All right. So if you remember the formula of EOQ, EOQ equals root 2 into 2 into ordering cost into annual demand divided by holding cost per unit. Okay. And ordering cost is again per order. So all the numbers are already given to us. We just have to write it down. Okay. So is equal to square root of 2 into ordering cost. Okay. So ordering cost is $200 per delivery. So 200 into its annual demand. So as I said, good, we have the annual demand. So into $10,000. Okay. Divided by holding cost. Now, holding cost, they say, is $4 plus 3% of purchase price. So it's $4 plus 3% of purchase price, and purchase price is $400. Okay. So bracket close. So 500 units. So we have 500 over here. All right. You could write this entire equation in your calculator also, on-screen calculator. If the square root functionality you are not able to find, you can also do, wait, I'll just copy this whole thing. Okay. The alternative way is, if you do not want to use the square root function, okay, is just raise to 1 by 2. Right, you will get the same answer. So square root is nothing but raised to 1 by 2. Okay, whichever method you do, you will get the same answer. Right, moving on. Which of the following statement concerning financial management are correct? So this is from the topic, the initial topics we did. It considers how investments will be financed. It considers how much profit should be distributed to shareholders, and it presents a picture of past operation and the state of affairs at the period end. Well, this sounds like accounts, okay, books of accounts that a financial management does not. But these two, yes, financial management has to deal with how investments will be financed. So sources, if you know that we have a chapter also on this, sources of funds and also cost of capital. Business finance is a topic entirely. It considers how much profit should be distributed to shareholders. So dividend policy is also a chapter in FM. However, all this is financial reporting or accountancy. So this is incorrect. So statement 1 and 2. So yeah, A is correct. Right. So A. Now, so in the exam, you will have like a checkbox or a radio button wherein you just click on the relevant option. There's no shading, but since I don't have it, so I'm shading the correct ones. Right? So HP company has 12 million shares in issue. and has just paid an ordinary dividend of $3.6 million. Last year, HP company implemented a 1-for-2 right issue. That is one new share for two existing shares. So even if this information bracket isn't given, you should understand the meaning of it. 3 years ago, the dividend was $1.6 million. What is the geometric average dividend growth rate per share for HP company over this period? So this question is a little tricky. Okay. 12 million shares in issue is today, and today's dividend is 3.6 million. But previously, we don't know how many shares were in circulation, and that time 1.6 million shares were given. So it's very now, if you remember geometric average dividend growth rate, it was, if you remember the formula, it was nothing but nth root. Okay, dividend today divided by dividend n years ago. So that was the formula. Okay, but instead of taking the entire dividend, I would suggest we take dividend per share, because the number of shares kept changing. So it's dividend per share is a better standardization. Okay. And as we all know that we need to be standard. Okay. All denominations should be standard. All right. So firstly, what we'll do, DPS, or the current DPS, you could say. Currently, the dividend per share is $3.6 million for 12 million shares. Okay, that is 0.3 per share. So this is $0.3 per share. And then how many years ago? 3 years ago. Okay. So 3 years ago, DPS is, now we don't know how many shares were issued 3 years ago. So we still don't know that. We just know that how much the dividends are. So now, today, there are 12 million shares. 3 years ago, we don't know how many shares were there. Okay. Wait, let me, because it's not a proper heading. Okay. So 12 years ago, 3 years ago, we knew, currently, so this is current. There are 12 million shares. 3 years ago, we don't know. But however, we know the ratio. For every two existing, one new was issued. That means currently in circulation, there are 3 shares, and previously there were only 2 shares in circulation. Okay, because only when you had 2 could you buy additional 1, and now there are 3. So just cross multiply 12 into 2 divided by 3. Okay, so 8 million shares are in circulation. Let's just put it so that there's no confusion. And this is in million. Okay, this is current, and this is 3 years ago. So now we know that it's 8 million. So the dividend 3 years ago is $1.6 million. So 1.6 divided by 8 million. So that is $0.2 or 20 cents. Okay. So now, very simply, we can just put in our formula. So third root, now instead of doing third root, we can just do raised to 1 by 3. Okay. So dividends today, or dividend per share today, that's 0.3 divided by dividends n years ago, which is 3 years ago. So actually, let's just use cell referencing. It's always a good habit to write, to always cell refer. This raised to 1 by how many? 3 years ago. So 1 by 3. That is 1 point, there is a -1. Okay. So this is a percentage, that is 14.47%. So we can just round it off to 14.5%. So let me just mark that. Yeah, 14.5%. So that's option D. Now moving on. Next question. B company has a cost of equity of 10%. The equity risk premium is estimated to be 6%, and B's equity beta is 1.2. Okay, B company has a debt beta of 0.02. Now, this is one interesting statement because normally we assume a debt beta to be zero. We assume debt to be risk-free. Okay. Anyways, so the rate of corporate tax is 20%. What is B company's post-tax cost of debt? All right. Now, this is a very different sort of question, and a lot of students would get lost over here because all information we have is relating to CAPM, and we never have dealt with debt beta. Okay, we have always taken debt beta as zero. Okay, and so yeah, how do we do it? It's very simple. Okay, you just have to use. So if you know the CAPM formula is equal to, do you remember it? Risk-free rate, okay? Sorry, risk-free rate plus beta into, okay, the market premium. What is market premium? The market returns minus your risk-free rate, okay? Let me just write this. Okay, I just got an indication that my system's laptop is low. Just give me a second. I'll connect it to the power. Just give me a second. Be back. Okay. Yeah. So this is the formula. Now we just need to use this formula and see what all things we have. Cost of equity, okay, or CAPM. Now this is as in the CAPM says that cost of equity is equal to risk-free rate plus beta into. Wait, I put the brackets wrong. Yeah, this is the formula. Okay, risk-free rate plus beta into the market premium. Market premium is market returns minus risk-free rate. Now from there we have cost of equity. So we have KE available to us. Then estimated equity risk premium, that is market premium, is available to us. That is 6%. So it is RM minus RF that we have, not RM. Okay, it is RM minus RF that we have 6%. And equity beta is 1.2. So we need to find the risk-free rate. Okay. Now, KE. So we already know that KE is 10%. So you'll write 10% is equal to risk-free rate. We don't know, RF plus. Now we know that it is beta. Now beta is 1.2 into the market premium, which is 6%. So this is what we need to solve. Now, if we take it to the other side, RF will be equal to 10% minus 1.2 into 6%. Okay, so we just need to solve that. So RF will be 10%. I've just not directly calculated it so that you understand how the calculations are done. Otherwise, you can just do it directly also. All right, so risk-free rate is 0.028. That is in percentage form is 2.8%. All right. Now you can use this to arrive at post-tax cost of debt. Now I know that using CAPM, we usually do not calculate cost of debt. Okay, because always beta is assumed to be zero. However, here explicitly beta, debt beta has been given, so we are going to use that only. Okay, we can directly use, we have the risk-free rate. All right, what we can do is, so KD, write it as this, KD is equal to risk-free rate, that is this, plus beta, debt beta is 0.2, right? 0.2 into the market premium, which is given to us, that is 6%, right? So 4% is our cost of debt. However, this is pre-tax cost of debt. A lot of students would just end up over here and mark this as the answer. However, they have asked us post-tax cost of debt, which means that 4% is the regular, as in pre-tax cost of debt. Now we need to put in tax. Corporate tax is 20%, so it will be is equal to this into the tax shield. So 1 minus tax, that is 20%. All right. So as a percentage, that is 3.2%. Okay, where is 3 point B? All right. So 3.2% is the final answer. This is pre-tax. Okay. And this one is post-tax. Sorry. Okay. So answer is 3.2%, that is B. Next question, question 13. CNH statements of profit and loss for the profit for the year ended 30th June 20x4. Revenue in $1,000, $280,000. Cost of goods sold is $140,000. Then we have gross profit to be $140,000. Assume all sales and all purchases are on credit, and there are no returns or discounts. All trade payables relate to cost of sales. So that's given explicitly. CNH statement of financial position as of 30th June. So the extract, so the balance sheet extract is given, inventory, receivables, cash, then payables, accrued interest, accrued income, income tax, all of that is given. Inventory balance of 30th June was 77,000. What is the length of the working capital cycle to 1 DP? Okay, so decimal DP stands for decimal points. Okay, so we basically need to find the days. Okay, the working capital cycle days. So let's see what all things we have. So inventory days plus receivable days minus payable days. Okay, now in order to find these days, we need to use our formula. Okay, I hope you remember the formula. It's the so it's like inventory divided by on what basis are you in valuing the inventory. So inventory in this particular case, since we don't have purchases and no other information, we can value it at cost of goods sold. Okay, so divide by cost into 365 or 360. Now nothing is mentioned. We can take 365, 360, whatever. Okay. Okay, it's mentioned 365 days, so we'll take it as 365 days. All right. So let's quickly do that calculation. Inventory days. Now inventory days will be is equal to inventory divided by it's valued on. Now if 2 years are given, you would have taken average inventory, but we just have data relating to one. Okay, into 365. All right. 200 and 200.75. Now they say that only one decimal point, but from the system point of view, it does not matter. It's just presentation. Okay, because the system is going to take 200.75, not 200.8. Right. Inventory days we took. Next one is After inventory, we have trade receivables. Receivable days. Again, receivables is 56 divided by receivables will value at sales. Okay, well, sales, that's revenue into 365. So that's 73 days and less payable days. Okay, so is equal to payables. Now they have explicitly given payables are to be valued at cost of sales. That is cost of goods sold into 365. Okay, so this will be a negative number because we are doing less, right? So then you can just see if you don't write negative, then from here, when you can't add all of them, you will minus them. So 164.3 days. So we have we have 164.3 days. All right. So C is the correct answer. Next question, question 14. The following statement relates to the money markets and capital market. Okay, so money market instruments are only traded over the counter between institutional investors. So money market instruments are correct. Okay, they are OTCs and they are see, as a retailer, we do not have a money market. Well, like, we do not participate in the money market. It's usually interbank. Okay. So yes, money market, and there are no standardized contracts to it. It can be custom. Okay. So this statement is true. Capital markets are markets for the medium term and long term financing. Okay. So this is uh, false. Okay. Because so capital markets are markets for medium term and long term. So capital markets are long term. Sorry, my mistake. Capital markets are for, yeah, so capital markets is the whole thing. This is for long term, whereas money markets instruments are only traded over the counter between institutional investors. This statement is true. Capital markets are markets for medium and long term. No, capital markets is long term. It's not medium term. Okay. Sorry, I got confused. Capital markets are only long term in nature. All right. So the correct answer, so this is true and this is false. So statement one is true. Statement two is true. Wait a minute, I'll just reread it. I'm a little confused over here. The following statement relate to the money market and capital market. Money market instruments are only OTC contracts between, which is true. Okay, sorry, which is false. Money market instruments. See, money market instruments are not traded over the counter. There are standardized contract, and but yeah, they are traded in the this thing. Institutional investors, even retailers. So, like for example, derivatives, okay, futures, and all, they are money market instruments at the end of the day. All right. So they are standardized. That is, they are exchange traded, and you and I can very well trade them. So this statement is actually false, not true. And statement number two, that is capital markets are markets for medium term and long term finance. Okay. Well, capital markets, yes, medium term and long term. Money market is short term. All right. So this statement is true. So statement number two, sorry, statement number one is false and statement number two is true. Okay, so let's see. Statement number one is true. That's incorrect. Both statement are true. Wait, statement number, yeah, okay. This seems to be correct. Option number B seems correct. Statement one is false. Okay, derivative instruments can be standardized. Okay, it's not necessarily always OTC. And capital markets, so there can be futures, there can be options, there are forwards also, but there are futures and options. Okay. And again, retailers can participate. Now, capital markets, so it is bank to bank also, retailers can also participate. Capital markets are medium and long term, money market is short, right? So, next question, question number 15. This is the last question of section A. A company has issued a 12% irredeemable bond at 95x interest. The rate of corporate tax is 30%. What is the post-tax cost to the company of this bond? Okay, now it is an irredeemable bond, so we can just directly use the formula. That is, if you remember, cost of debt is equal to interest into the tax shield. Okay, the whole thing is divided by your price, okay, as in your market value. Okay, market value of P0 you can write. All right, so we have the coupon, that is 12%. 12% basically means on $100, that will be $12. So is equal to $12 into 1 minus T. It's nothing but your yield, right? So your interest divided by your market value or the price which is currently being quoted. Now, interest will be, now you're thinking from the point of view of the company. That's why it's always post tax. Plus, they have explicitly given to us it's post tax. So 1 minus T minus 30%. Okay, divided by the market value. The market value will be $95 x interest. Let me just put in a proper bracket. So defining the numerator explicitly. Okay, just to avoid any calculations. All right. So as a percentage, this is 8.84. So option A. Okay. With this, we are done with section A. It took us less than an hour. All right. So it was very quick to do. Now we'll move on to section B. So before we move on to section B, let's take like a quick 10 minutes break and then we shall continue with section B. Okay. So see you in 10. All right, welcome back. So let's start with section B. Again, as I said, pause before answering. As in, once I read the question, pause before you see my answer. Just as a good practice. Okay, so FKP is a wholesale distributor of, now again, section B, there are 3 questions now with 5 sub questions. So this particular case deals with question number 16 to 20. Okay. FKP is a wholesale distributor of non-perishable grocery items to a range of retailers. The following statement of financial position is available for last 2 years. So year 1, year 2. Year 2 is the most recent year. Trade payables are given, trade receivables, cash and cash equivalents, inventory. During year 2, sales averaged 270,000 per month and cost of sales averaged 210,000 per month. All sales are on credit. FKP's operating cycle is 55 years. Sales are forecasted to rise in year 3 by 20%. The industry average operating cycle is 50 days. So we can see that this one is a little more than the industry average. Assume a 365 year. What are trade receivables and trade payables day for year 2 using average balances? So we have already used it in section A. Okay, same formula. Okay, so here we have to find the period. So we'll just write receivables. Okay, and now receivables, if you know, uh, you will take the receivable value divided by what they are being valued on. In it will be credit sales into 365 days. Okay, so you will take your receivables. Now they have said average receivables and on based on average balances. Okay, so average we'll take opening plus closing divided by 2. Right, so we are taking, so this plus this divided by 2, sorry, 2. Okay, the whole thing divided by credit sales. Now sales we have for year 2 is 270,000 per month. We want annual sales, so 270,000 into 12. Don't write 270, everything is in complete number. So we'll write numerator also. Let me just put a bracket. Okay. So receivable days is, wait, there seems to be some error. How can it be? We need days. Did I take receivables? Oh, I didn't take the proper numbers. Wait, I don't know how the cells got shifted. This, why is it selecting D12? It's not D12, it's, okay, I'll just manually type it in. It's E12. Yeah, E12 divided by, oh, sorry, E12 plus, it is this. I don't know why the other cell is getting calculated. Okay, G12. Okay. There seems to be some. Let me just type in the values manually. Maybe then it would work. So it is 700,000 plus. If you're typing manually, then we could have just done 700 plus 750 divided by 2. Okay. Still that 700 plus. Wait, let me just redo it. 700 plus 750 into, or rather divided by 2. This is the numerator. Okay. Divided by our sales. So sales is 270 into 12 into 365 days. Yeah, now I got it. Okay, so that's 81.6, or we can round it up to 82 days also. Okay, and so yeah, we have 82 days. So we need not, in this particular case, we need not even find the payables. All right, that's why it's always a good idea to check. So your option D seems correct because that's the only one with 82 days. Okay, and also over here, all the receivable days are unique. All right, so we could have just find receivable days, no need to waste time doing payable days. All right, so be smart in the exam, save time wherever possible. So question number 17, assuming that the relationship between FKP sales and and working capital excluding cash remains unchanged, how much extra working capital finance will be required to support the increase in sales for year 3? So they are saying that sales to working capital remains same, and in working capital we do not take cash, is what they are saying. Um, how much extra financing is required to support an increase in sales? So increase in sales is how much? Firstly, what is the requirement? Okay, so if we have to say working capital excluding sales, so wait a minute. Now our working capital will be 595. Sorry, that's payable. So current, no, this, yeah, okay. Current asset has payables and receivables. I didn't quite, I think there is some typo in the question because trade payables should be current liabilities. So just ignore that. I think trade payables should come down. And anyways, you know what it is. Okay, so we won't. So yeah, there could be typos certain times in the question paper. So just don't get confused. This is actually current liability, and these all are our current assets. Okay, so 750 plus 468. Okay, we do not take cash and cash equivalent because it's asked not to take that, and minus 595. So 750 plus 468 minus 595. Okay, so net working capital is 750 plus 468 minus 595. All right, so 623,000 is excluding cash. All right, the net working capital. Now they say that sales for year 3, what is required? Okay, the formula is sales by net working capital. If sales goes up by what they have said, sales 3 in year 3 is expected to go up by 20%. If sales is expected to go up by 30% and to maintain the same ratio of sales to net working capital, then net working capital also needs to go up by 30%. Okay, so sales expected to therefore to maintain same uh, sales to NWC, the net working capital shall also go up by 30%. Okay, this I'm just writing for your reference. In exam, you can just directly calculate 30% increase of it. So they are asking by how much should it increase? Point, oops. Okay, 180 186.9. It should increase by 186.9. Sorry, it's not 30%. It was 20%. My mistake. Be 0.2. Right, so 124.6, which is over here. So let me just 20%. Thank you for correcting me. Okay, so $124,600. So this is so option A is correct. Question 18. FKP's cash operating cycle is longer than the industry average, which we observed. What might this indicate? So FKP pays its supplier more quickly than the industry average. Yes, when we are finding our operating cycle, we do less payable period. So this is a possibility. Now we don't know how many statements we need to mark. Okay, in exam, maybe you just try marking 2. If it allows you, then okay. Else, they just want 1. Otherwise, you know what will happen when you mark something and you try marking other. The first one which you mark would disappear and it will get allotted to the one which you recently marked. Okay, so this seems correct. FKP holds less inventory than the industry average. Well, in fact, if it had less inventory, then the inventory days would reduce, which is not correct. FKP is undercapitalized. That is also incorrect. Okay. FKP, otherwise, it would have money to pay its. So, no, this is not correct. FKP's debtors pay more quickly than the industry average. No, if they would have paid more quickly, we would have received money quickly. Therefore, our operating cycle would be less. In fact, capitalization doesn't have to do, there's no direct impact to the operating cycle. Operating cycle is nothing but your uh, inventory days plus receivable days minus your payable days. Okay, so this I think is the only correct one. All right, so option A. Right. Question 19. FKP is concerned about overtrading in the future. Which of the following is a symptom of overtrading? Now, if you remember, everything in working capital had to do with profitability versus liquidity, and overtrading focused mainly on profitability. Now, in order to earn profits, okay, and not focus on liquidity. So in order to focus on profits, what are you going to do? You are going to have more inventory, okay, because if you have more inventory, you can sell. Like a customer can just walk in and say that you can say, yes, I have it already in the go down, I can deliver it to you immediately. Great, and he will make the purchase. If you do not have it in your inventory, you will say, oh, it will take 1 week for me to arrange for that particular good, and the customer may go to some other shop and look elsewhere. Okay, so inventory higher, and also to improve your sales or profitability, you are going to give extended credit period also to the customer. All right, so overtrading has to do with increased current asset and reduced current liability. Okay, so what are the symptoms? The cash operating cycle falls. Yes, that is very much a symptom of it. Okay, because the cash operating cycle falls. No, 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 no. In fact, it would increase because the current assets are increasing. So it's going to take more days for you. So this is incorrect. The payment period of creditors shorten. Well, that's not true. Our liabilities, as in current liabilities, go up. So it's going to take extended because you're going to get money late. So you're going to pay money late. Inventory day turnover slows down. So so inventory turnover is sales to inventory. Now, if your inventory levels go up and sales does not improve that much, then yes, inventory turnover could slow down, and debtor pays more quickly. Well, debtors are not going to pay any quick. Okay, in fact, you're going to give them more credit period, so they're going to pay later. So section C seems to be the only right answer. So not section C, sorry, option C. I don't know why I keep saying section. Option C. Okay. Question number 20. Again, so all these questions were dealing with that case study. Now, FKP decides to offer 5% early settlement discount. That's 75% of the customers take up. The impact of this discount is that these customers will pay a month earlier than he are currently paying. Sorry, than they are currently paying. FKP pays 8% per annum for its overdraft facility. What will be the impact of the discount have on the cash operating cycle and the reported profits? Now, impact on the cash operating cycle. See, if you are giving early settlement discounts and 75% of the customers are taking it, okay, and paying early by a month, what's going to happen is, since they're paying early, your receivables, okay, receivable days will reduce. If they will reduce, your overall cash operating cycle will reduce. So it's either option B or it's option D. Okay, either or. Now we need to figure out what impact does it have on our profits. Okay, because on one side, when you are giving discounts, right, the amount is reducing obviously, but there is some benefit also. You would not have to take overdraft facility. So you need to see that, or you need to calculate that whether the discounts that we are offering are more than, okay, because discount is kind of like a cost to us. It's going, we are receiving less, so it's like a cost to us. We have to see whether the cost is able to justify the benefits. Okay, so let's see what are our costs. The cost is 5% discount on a sale of, now which year? I think we are to do with the current year only because nothing explicitly is mentioned. Okay, so we have to go back to the question and see the sales figures. Okay, so the sales average 270 per month, which means we have to find out annual sales, because we are calculating annually how much is the discount we are going to provide. Okay, into 12. Now, only 75% of the people are going to take this. All right, let me put the is equal to sign in the beginning, otherwise become as is. Okay, so this much, $121.5 thousand is what discount given in a year. Okay, so this is the discount that we give in a year. Now, FKP pays 8%. For overdraft facility, 8% is what we have to pay. Since we are getting this money a month earlier, so we have to take 1 month less of overdraft facility. Okay, so savings in OD. So savings is 8%. Okay, into that same sales amount because that's our base. Okay, now 8% is per annum. We have to do 1 month only, so 1/12. Okay, into the same total sales. That was, what was the sales? Wait, sales was 217 to 12. Okay, so 8% into 1/12, because only 1 month saving, into 270 into 12. All right, so this is the sales, and yeah, and okay, 75% of the people only take it, so 0.75. So 16.2. So the savings is not able to justify the costs. So what's going to happen? Cost is more, so our profitability is going to reduce. So B is the correct answer. All right. 21. GSF is concerned. Oh, okay. This is a new question. So this is a new case study. We did 5 questions. Now moving on to the next case. So GSF, a company based in Westland, has agreed a sale to a company in Germany. So we are a Westland based company selling to Germany. The currency in Westland is Westland dollars, and the currency in Germany is euros. Um, the sale is on 3 months credit period and has a value of 1,650,000 dollars. Sorry, 650 euros. Assume that the date is currently 15th of June. Currency market rates are on 15 June are as follows. So they have given us a spot rate, 3 months forward rate, and they have given a 3 month, expected spot rate in 3 months time. Money market on the 15th of June are, so this is after, no, okay, this is also spot rates. So money market rates, we have borrowing and deposit rates. Let me just delete this here. Or wait. Okay. Money market rates are given, deposits and borrowing rates are given to us. So this is the case study. GSF is concerned about the cash it is due to receive from overseas sales will not be as expected due to exchange rate movement. Okay, before we start this, I just want to comment on the previous question. So if you saw the previous section B question, it had a mix of both theory as well as calculation. So therefore, you must not skip theory, and especially MCQ based theory, easy marks to score. GSF is concerned that the cash is due to receive from overseas will not be as expected due to exchange rate movement. Okay, what type of risk is this? Is it a translation risk? No, translation risk is a bookish risk. Okay, when you are reporting from one year to the other and combining all the figures, okay, that's when that risk arises. It's not even in fact a real risk, so it's not translation risk. Economic risk is more long term in nature, has to do with the economy, therefore long term change in foreign exchange. Business risk does not have to do much with foreign exchange at all. So lastly, transaction risk, and yes, since you're getting the money later, okay, so there is transaction risk. Because currently it may be, say, how much it is. Okay, you are to receive 1,650. Now, if 1,650 gets converted into Westland dollar, okay, whatever the relevant rate is, after 3 months, this rate could change. All right, so that is transaction risk. It's based on transaction because the date of invoicing and the date of transaction are two different dates. Now, question number 22. So the previous question was D, transaction risk. 22, calculate the amount in W dollars that GSF will expect to receive if a forward contract is used. So we are using a forward contract. What are the details related to 3 years forward contract? So this is the 3-year forward contract details. Okay. This is 3-year forward contract, and how much amount are we talking? 1,650 euros. Okay, so it's euro 1,006, sorry, 1.650 million. Okay, 1.6. Just put it in dollar terms. Okay, right. Yeah. Why is this coming? Okay, anyways, fine. So we are to receive euros 1.65 million. Okay, sorry, this is not dollars. This is euros. Let me just change the currency to euros. Yeah. Okay. Now we need to understand which rate should apply to us. €1 is equal to how many W dollars or Westland dollars? It's either 1.2533 or 1.2601. Now think of it this way. If we go to the bank with the euros that we have, the bank is going to take more euros from us and is going to give us as little W dollars as possible. Okay, so it's going to take more euros, which means 1.2601, which basically means we are going to say that €1 is equal to 1.2601. Okay, so if we have these many euros, then this into this. All right, 2079. Sorry, this is W dollars. Okay, 2079 is what they are showing. Why? It's none of them. And if 1650, sorry, 2067, none of them are here. What is happening? Wait, there's some mistake I have made. Calculate the amount in W dollar that GSF is expected to receive if the forward contract is used. The sale is on 3 months credit term and has a value of 160 $1,650,000. Okay. Euro per okay, sorry, I just read the quote wrongly. Okay, it's how many euros per W dollar. So this is one W dollar. Okay, wait, let me just redo it. Okay. So it was euro per W dollar. That means one W dollar is either equal to 1.2533 or it's equal to 1.2601. Okay, that's the quote available. Now, if you have to think of it, see, one way of doing it is you do both and see where you are making a loss because banks always make a profit. Okay, so see in which case do you receive the least W dollars. So this would be in dollars. Okay, so you are receiving least dollars over here. That is 1,309,419. Okay, let me just. All right, so you can just say that this is the final answer. Else, if you want to think of it logically, you don't want to do double calculations. Well, you have to say that, okay, for every euro that I give, okay, because we are going to receive in euros, we are selling it in, so every euro we will give, how many dollars are the bank going to give us? Okay, so we have euro and the rates given is for every dollar, what is the euro? Okay, so it's going to take more euros from us. All right, we have euros, so these are euro numbers. So it's going to take more euros from us, that is 1.2601, and in exchange going to give us lesser dollars. All right. To avoid any confusion, I would suggest you take a little more time, do this so that it's clear to you and this is an easy 2 mark for you. Okay. Also, there's the other logic that bank always sells high and buys low. All right. So depending on what the bank is going to do, now in this case, the bank is going to buy our, is going to sell us euros. Okay. Sorry, sell us the dollars. It's going to buy euros. Okay. So accordingly, you can use that logic and also get the answer. Now, question number 23. Which of the following statements are true of a forward contract? So they are binding contract. Yes, they are an obligation. They are binding. So that's true. They can be sold on to someone else. No, forwards cannot be sold to someone else. They are OTC. They are not exchange traded. So you cannot sell it to someone else. Okay. So this is false. They fix the rate for a future transaction. Yes, they fix a rate. Okay. Irrespective of whether there's an adverse or favorable movement, you will have to pay it on the locked in rate. They are flexible once agreed. No, that is options. It's not future. So 1 and 3. Okay, so not A, 1 and 3. Yeah, B. So option B for question number 23. Now question number 24. Which theory can be applied to calculate forward exchange rates using nominal interest rates? So purchasing power parity theory, Fisher's in IRPT expectation theory. So whoever remembers this theory, they would easily get this. Okay. This one is IRPT. All right. IRPT gives us forward rates, whereas PPPT gives us future rate. Fisher theory and expectation theory do not give us a rate. Fisher theory is just the linkage between real and nominal. So the inflation, okay, and expectation theory is just giving us expected spot rates. All right. So IRPT is the correct answer for question 24. So that's option C. Question number 25. Now calculate the amount in W dollars that GSF will expect to receive if money market hedge is used. Now, if you remember money market hedge, we invest in the we do a transaction in the foreign country and then we do a transaction in the base country also. Now, we need to decide whether in the foreign country do we create a deposit or so that's the first question we need to ask ourselves. Do we create a deposit? Okay, that is, do we invest in the foreign country or do we borrow in the other country? Now, to answer that, we need to ask that are we going to receive the foreign amount or do we have to pay the foreign currency? Okay, in this case, we are going to export it to some country in Germany. That means we are going to receive that $1.65 million, million euros. Okay, so we are going to receive, which case today in Germany we are going to create an obligation. That is, we are going to borrow in Germany. Okay, so Germany, I'll just write it down. Okay, now to borrow in Germany, wait, let me just, yeah. So to borrow in Germany, at what rate? Now I think it was question 21. Okay. Germany can borrow 1.4% at 1.4%. Now this 1.4%, this 1.4% is per annum. Okay, so for 3 months, this is per annum. Okay, 3 monthly rate is equal to, all right, so 0.35%. Now, how much amount do we need to borrow? Okay, so it's like we have the future value, we need the present value. Okay, so it's like a discounting. So amount to be borrowed, just present value terms, right? So is equal to 160 or $1.65 million divided by 1 plus r raised to n. Now I have already adjusted the rate, so we need not do anything raised to n. Okay, so it is 1.645 million euros. Okay, these many million euros we need to borrow. Okay, however, we are dealing in, we are a Westland country or whatever that country's name was. What is it? Westland, yeah. So we are in Westland, so we need to deposit in Westland. Now, how much do we deposit in Westland? Whatever dollar, whatever euro loan that we have taken, we bring it to our country. That is, we convert it. Now we convert it on spot rate basis. So our spot rates are available to us. Now understand this again. This is euro per W dollars. So 1 W dollar is equal to 1.2552 euros or 1.2564 euros. So we have euros with us. We'll go to the bank. Okay. Bank is going to give us, now for every euro that we give to the bank is going to take more euros from us, going to give less W dollars to us. Okay. If you don't get that logic very clearly, you can just do a quick calculation. Okay. Oops. Yeah. Spot rates are such. Now, if say if 1 W dollar is equal to 1.2552, or else it is 1.2564. Okay, we are to receive these many euros. So a cross multiplication. All right, just copy the same thing. Okay, now the decimal points we would have to, because it's million dollars, right? So we would need to actually, what we can do is into, or no problem, we'll just increase the decimals and we'll get a better idea. Oh, sorry, my rates I forgot to, no, I changed it now. 1.309946735. Why am I getting the same answer? Oh, okay. Okay. So we can see here that we are going to receive less. So this will be our spot rate. So basically we are going to, is equal to these many W dollars. All right. These many rather million W dollars is what we are going to invest. And on that, we are going to earn, what is the, I understand it becomes a little difficult to switch screens. So Westland deposit rate is 2.6%. Okay. So 2.6%. Again, you are doing it only for 3 months. So put this into 2.6%. Now it's amount received. So now we need the future value. So into 1 plus R. R is 2.6% into 3 by 12. Just doing it directly. All right. So it's 1.317202. Okay, 114. So B is the correct answer. All right, little lengthy calculations, but needs to be done. And we took it in millions, so they are all in decimal, but here it's a full thing. Okay. I hope money market hedge. So money market hedge can come like this, a very quick calculation. No tricks, nothing, very simple. Question number 26, right? The following scenario relates to question 26 to 30. HSD is a well-established, unlisted service company with a strong reputation for the quality of its staff. The four directors and the other only shareholders are considering selling the company and have had inquiries over several interested parties. One of these inquiries is from VVS Company, a similar listed service company with branches across the country. The following information is available on both VVS and HSD companies. So they are basically selling off their company to someone who is similar. Now they have given the number of shares, EPS, DPS, a net book value, that is long-term assets, current liabilities, share price of VVS company currently. HSD is not given. Maybe it's unlisted. Okay. A similar listed company. So HSD price is not given. Exchange rate, expected annual rate of growth in earnings is given, expected annual rate of growth in dividends is given, cost of equity is given. So a lot of a lot of things are given. Forecast annual growth rate for HSD have been internally generated based on HSD current policy of reinvesting 50% of its earnings. So its reserves are growing at 50% of the earnings, and earnings also are growing. Forecasted rates for VVS have been estimated by independent third party. Not a very important information for us from exam point of view. HSD has non-current asset of $2 million, which are valued at 0.75 below net realizable value. So it's actually the book value is 2 million. However, when they had to revalue it, okay, they realized that it's actually less than that. HSD has 0.25 million of receivables, which are now not thought to be recoverable. Okay, so receivables, there are bad debts basically. Okay, so this reduces, this also reduces. On a realizable value basis, what is the net asset value? So this is not, so NAV stands for net asset value. Sometimes NPV. You just read N and V and you think NPV. Okay, it is NAV, that is net asset value. Okay, net asset value, just add up all the assets and reduce all liabilities. Okay, so let's do that. HSD company, we'll add up all assets. Now in the assets, we have non-current assets that are long-term in nature, plus current liabilities. Okay, this plus, okay, there is no other asset, so minus current liabilities. Okay, however, so normally you would just do 4.25 and people just mark 4.25. However, in the notes, they have mentioned that 0.75 below realizable value and 0.25 of receivables are now thought to be recoverable, are not thought to be recoverable. Okay. So minus 0.75 minus 0.25. Are these in million dollars? Yes, they are. Okay. So 3.25. All right. So 26 will be, uh, wait, sorry. Uh, Wait, let's just read everything else. Non-current asset of $2 million are valued at 0.75. Okay, sorry. So actually, there was something worth 2 million, okay, which are now valued at 0.75, which means it's not just reduction. I didn't read this 2 million. I just wrote minus 0.75. Okay. It's basically $2 million worth of current assets. So what is happening is, this is straightforward. This is just reduce by 0.25. What is actually happening is our non-current assets are worth 3.5. Now in this, there is something which should be less 2 million, okay, and added 0.75. Okay, so it's basically valued at 2.25. So what we are going to do is our fixed asset valuation or non-current asset valuation will be book value. Okay. And then we would say, so this was actually book value. However, there was something that is worth $2 million, but it's no longer worth 2 million, but it is worth 0.75. It gets reduced to 0.75. So that much portion you are removing. Okay, so minus 2 million, and then you are adding 0.75 to it. Okay, so 2.25, what we did previously is a common mistake. I also made that mistake right now, but just realized it and I didn't read this. Okay, so 2.25 is the non-current asset, and then our current, so receivables. So our current assets will also be, the book value is, current asset is 1.25. Oh, sorry, I can't refer. 1.25. Now this becomes 0.75. So these are the two different effects. 0.75. Okay. So what we are going to do is this plus this minus, now there is nothing in current liabilities. So minus 0.5. Okay. Am I missing out on something else? Oh, sorry. It's valued at 0.75 below net realizable value. So 2 million one is just below 0.75 million. So it's reduced by 0.75. Wait, okay, my internet is not stable. Wait a minute. Okay, let's just take a break. I think the net should be back. Wait, we'll just take a break. Okay, so I think my net is back and it's more stable. I can see that the speed is better. I hope. Uh, all right, great. Okay, so it's proper now, right? Yeah, so we were doing this. HSD has a non-current asset of 2 million, which are valued at 0.75 million below net realizable value. Okay, so what they are trying to say is um, there are assets which are worth $2 million, but they are valued below by 0.75. Okay, so we need to bring it up to its normalcy. So we have to add 0.75. Okay, so very simple. Wait. So in net asset value, what happens is you're taking all the assets. So we have our current assets plus non-current assets minus your current liabilities. Okay. Now it is valued lower. So whatever this valuation is over here, it is valued lower. We realize that 0.75 should be higher. So plus 0.75. And then receivables have turned bad debt. So minus 0.25. Okay. So 4.75, which is D, is our correct answer. Okay. The statement says HSD has non-current assets of 2 million, which are valued at 0.75 million below net realizable value. Okay, so we need to value it higher and bring it at par to the net realizable value, because we value the NAV valuation is done on net realizable value and not book values. Okay, question number 20. So that was a tricky part in it. And we did all the mistakes. So in one, we got 4.25, in the other, we got 3.25. These are the common mistakes. Okay, in D, and also I made those mistakes. In D, no, so when we corrected ourselves, we got a D. Okay, that is the correct one. Moving on, question number 27. Using estimated annual earnings next year and applying the PE multiple that currently applies to VVS company, what is the valuation of HSD company? Okay. So using estimated annual earnings next year. So what is the estimated annual earnings next year? Okay. Number of shares, all of that is doing. Expected annual percentage of growth in earnings. Okay. Next year is 3 and 2.5. This is HSD. Okay. So we are asked to value. What is the valuation of HSD company? Okay, so the estimated growth rate for or growth in earnings for HSD is 2.5%. And that's the growth. How much is it making? Now we have earnings per share. We don't have, so if the earnings per share is 60, now this is 60 cents. Okay. Uh, if we want to calculate how much is our entire profits, okay, so 60 into number of shares will be, so I'll just do the calculation here because it's simpler that way. Okay, so my profit will be 1.2 into 0.60, because understand 1.2 million shares and 60 cents. Okay, so do not multiply it into 60, it will be 0.60. All right. So this is the sales of HSD, okay, in dollar million. All right. So our sales is 0.72, and we know that there is a growth of 0.5%. So there's a growth, right? So we'll take our base, which is the sales, into 1 plus the growth rate. That's 2.5. now 2.5%. That's important. So 0.738 is what? So this is, you can write, this is not sales, this is actually profit. This is sales. This is after our sales growth. Okay, this is all year 3. I think we have been asked because, yeah, next year. Okay, so this is next year. Okay, so we got the next year sales. Okay, and we have the next year. No, this is not next year. In fact, this is this year's current year. Wait. Current year PAT, and then this is not sales. This is growth in earnings. So expected. Sorry. Next year expected profit after tax, right? So 0.738 is the EPS, or the earnings, total earnings that we are expecting for the next year. Now, they say that the same PE multiple of VVS shall apply. Okay, so the same PE multiple. So we first need to find what is the PE multiple of VVS. Okay, so price to earning. What is the price? Do we have price? Yeah, 450 cents. So 450 cent, that's price to earnings. Earnings are also in cents, so 450. So that's 10 times. All right. So we have to put 10 times. So the price, okay, this share price will be, where do I write it? I'll just write it here. Okay, so the ideal share price should be, if we assume that it's 10 times, okay, 10 times the multiple, sorry, the PAT or earnings, okay, $7.38 million. Right, so the valuation is $7.38 million. Okay, so let me just mark this. I'll bring this calculation over here. Or how do I show it? I just didn't want to switch tabs. That's why I was doing it here. But how do I copy it? Okay, leave. You can always refer to it. You understood how I did the calculations, right? So first I found the total sales. Okay, then I put, sorry, not total sales, total profits. Then I added the growth to the profits. So arrived at the estimated profits next year. Then with the PE multiple, that is price to earning, we already have the earnings. We multiply the PE ratio of VBS to get our company's valuation. Okay, so that's $7.38 million. Now, why is it not appropriate to value a company such as HSD based upon its asset value alone? Now, if you see, is an unlisted service with a strong reputation for the quality of its stuff. So it's basically a service-based industry. Okay, one of the similar inquiries listed services company. So VVS is also a similar company. It's a service-based company. So these companies are service-based. Okay. So they are asking, why is it not a good idea to value it upon its asset values alone? Market values of assets are likely to increase before a deal can be finalized. This is true. Okay. But is it very relevant to HSD? Okay, so now if we can mark multiple answers, we will mark this because it is true. Market value of assets can change. A large part of a service company's value lies in the skill and knowledge of its personnels, which is true. Like if you think of a service-based industry, the human resource, the human mind is more important. Like for example, even IT company, it's a service-based technologies is services. Okay, so it's the human mind. They do not in fixed asset. They have maybe computers, but you know how much. So humans are more valuable than computers. Okay, so it's that personnel, the knowledge of the personnel and the skill. That's a huge reason why the company is able to do the sales. Okay, and get a valuation based on their human resources. Shareholders will be unwilling to sell a company for its asset value alone, which is also true. Uh, Market values of assets rarely bear a close relationship to their earnings capacity, which can partially be true also. Okay. Now, if we had to pick one, and which is saying only about HSD company, why is it not appropriate to value? So, the specific reason for HSD, for a service based company, okay, would be this. Otherwise, everyone are true in its own, but this is where I said by hearting theory is not going to help you, because if you would have by hearted theory, you would say all of these statements are true. Okay, however, case specific, it is only this. Other statements are generic. Question number 29. What is the valuation of HSD using dividend valuation model? Okay, so dividend valuation model would be D1 divided by your rate. Okay, so P0 is D1 divided by your rate. Now let's see if we have those rates and all. I think it was question number. Okay, firstly, we need dividend. So, any information on dividend? Yeah, so dividend per share has been given to us. Okay, it's 30 cents. So, that would be 30 into, again, we'll do the calculations here because it's easier. So, it's now, again, it won't be 30, okay, as in it will be 0.3 because this is cents. Okay, so 0.3, that is $36 million is the dividend. Okay. Now we want not D0, we want with the growth because there is growth mentioned, which is 3%. Okay, so D1 will be this, right? This into 3% of growth, right? So 3% growth, it will be 1 plus 3%. Right, so 3.7 million, you could say. I'll just write it. It's D1. This is current dividend is 0. Okay. Or let me just write it this way. Right. So now we found the dividend. We need to find our price. We have our total EPS, earnings per share. All right. We just need to find, or we can just use the rate. So our cost of equity is now we if we assume that because we don't have the cost of equity for HSD, we can assume that it's going to be same because it's a similar. So we are using it as a proxy cost of equity because nowhere else have they given us that there is what is the cost of equity, okay, for or any information for it. Okay, so we can use 13% as cost of equity, and growth rate is 3%. So we can just use that formula. So our dividend is $0.37 million. So we can just take, in fact, I'll just show you, since we are using this spreadsheet over here. Wait, which question were we in? Yeah. What we can do is we can directly refer to that cell. So it's this divided by 13% minus KE minus G. Okay, growth rate is 3%. Okay, so 3.708, which is close to this 3.71 million. All right, so C is our correct answer. Now, next question. The use of the dividend valuation model to value HSD is based upon a number of assumptions. Which of the following is not one of these assumptions? Okay, so as we calculated, we used the assumption that the cost of equity will be same. Now, which is not an assumption. The current year dividend does not vary significantly from the trend. Well, that is an assumption because we use the growth rate, okay, which has been consistent. Future dividends will continue to grow at the same rate as they do not, as they have done in the past. Okay. The cost of equity for HSD can be reliably estimated, and investors act rationally. So the question says, which of the following is not one of these assumptions? So we assume that uh, current year dividend does not vary significantly from the trend. Then this is so investors act rationally. We assume the cost of equity for HSD can be reliably estimated. We have assumed. Okay, but this we cannot is not one of those assumptions. Okay, we have separately assumed it, but okay, so just mark this statement B. All right, we are running short of time. Section C, PLK. So now we are on the bigger questions. PLK company is considering investing in a new machinery as part of a launch of a new product, the Quago. The new machine is exposed to have a useful life of 4 years and could be bought for $1 million, half of which could be paid immediately, with the rest payable in years' time. The scrap value of the machine after 4 years would be $30,000. The sales revenue and variable cost for Quago in each of the 4 years are expected to be as follows. Inflations have been included. So the numbers have already been inflated. Okay, so we have year 1, 2, 3, 4. Production and sales has been given. Okay. Now, as we have done all big questions, firstly, before we read all of this, let us just find out what we need to do. Okay. Calculate the following values for the proposed investment in new machinery and comment on your finding. Net present value and IRR we need to calculate. Okay, what are the strengths and weaknesses of the IRR on basis for PLK's investment appraisal? And some member of the board of PLK were wondering why ROCE and payback period have not been considered for its investment proposal. Discuss the reasons why NPV is theoretically preferred to these other investment appraisal methods. If you remember, we have done, I think, the same or a very similar question in classes. Okay, but well, this separate YouTube live, so we'll discuss it. Okay, but we have done, my students would remember, we have done something similar. Okay, anyways, so these two are theory. Okay, so Why are payback and ROCE not considered? You can speak about the disadvantages of payback and ROCE. So ROCE is based on accounting profits. It does not contribute to shareholders' wealth maximization. Payback period also does not consider, though it is cash flow based, it does not consider time value of money. It doesn't give a clear cut decision. Even ROCE doesn't give a clear cut decision. So all of that. Okay, and then you can speak about why NPV is preferred. Okay, because NPV, if you see that it actually does lead to shareholders' wealth maximization, it is an absolute value. It's easy to understand, though difficult to calculate, but easy to understand. Okay, so majorly for NPV, the major benefit is that it adds to the shareholders' wealth maximization. It is cash flow based. It does consider time value of money. All of that. Okay. What are the strengths and weaknesses of the IRR method as basis of PLKs? Okay, so you're explicitly, so basically all the methods of valuation, investment appraisal, whatever we have learned, all of their strengths and weaknesses, but however, we shall relate it to PLK. Okay, it won't be just separately written. Now calculate the present value for the proposed investment. Yeah, so we have to find NPV and IRR. So our regular table, how we did it in yesterday's class. Okay, your sales, fixed cost, variable cost, all of that. Okay, find net cash flow, then tax, your TAD, all of that. But here there is also working capital requirements given, so there is another working capital adjustment that needs to be made. So let's first make our financial summary. Okay, PLK is considering a new machine is expected to have a life of 4 years, could be bought for 1 million, half of which to be paid. So cost of machinery, okay, is $1 million and half is paid today. So initial investment will be half of this. Okay. And then uh, so half of which would be paid immediately with the rest payable in a year's time. And in the next year, we are paying the other half. All right. So this is a different one which we are not used to. Okay, so there are two capital investments, one in year 0, one in year 1. Which of okay, the scrap value of machine after 4 years would be $30,000. So after 4 years, in fact, let me just write this as a million only. Okay, let's put it all in $1 million so I know the commas. Yeah, all numbers and dollars. Okay, so scrap after 4 years was $30,000. So this is our scrap value. What next? Sales value and variable cost for cargo in each of the 4 years are expected to be as follows. Inflation has been included. So we have production, we have sales, and we have variable cost. So we can use this table as is. No need to copy paste it. Or let's just do it or leave, no problem. Fixed costs relating to the project will be $10 per unit in the first year. The fixed cost is expected to remain unchanged in price terms throughout the project and no inflation is expected. So fixed costs would remain as is, no inflation in it. Producing and selling the cargo will mean increasing investments in working capital is required, but this will be recovered at the end of the project. The requirement at the beginning of each year is as follows. So, working capital requirements have been given to us. But remember that, again, students forget this. In fact, we should write it down, is that cargo so will be recovered at the end of the project. Okay, so the working capital is recovered at end of the project. Okay, there is a recovery in working capital, whatever we have invested in that, right? Then what else? So these are the working capital requirements. We will have to infuse that much amount every month, and then the summation or whatever we'll get. Uh, so the requirement was 100, so we pump in 100. Then the next month, next year, the requirement is 120, out of which 100 is already invested. So 20 will be pumped in. Then an additional 30 will get pumped in because 120 is already pumped or invested. So additional 30 will be invested so that we receive 150. Then it becomes 110, which means there is a release in working capital. And in the fifth year, the entire 110 will get released. Okay, we'll do that. I'll show you how to do this. Okay. PLK company pays tax 1 years in arrear at an annual rate of 30% and can claim a depreciation of 25%. So tax allowable depreciation is was it 25%? Yeah, 25% and 30%. So 25% and tax paid 1 year in arrears is 30%. Right. The first claim of tax allowance on purchase cost will occur at the end of the first year and will relate to the full purchase cost of machinery. A balancing allowance is made at the end of the final year of operation. PLK uses a balancing allowance is claimed at the end of the, so for this is relating to the asset. Okay. Then PLK company uses a nominal, that is money term after tax cost of capital of 15% for investment appraisal. Okay, so we have our nominal rate and all the figures are also in nominal, as in they are already hiked with the inflation. Okay, even if you are confused, even if you feel that no, I should be using real rate, there is no inflation rate given. So that's your other cue, but that's not the right cue. The right way of understanding is these figures are already in nominal terms, they are already inflated. Then we are going to take the nominal discounting rate. Okay, so now no adjustment needs to be made over here. So let's start with our, so firstly we need to label. So this is subsection A, question 31. So question 31, subsection A, right? And then we have, what is this? Calculating the NPV of the Quago, or just of the project. We could just write that. Ideally, just write of Quago project. Anyways, year. So let's. It was a 4-year project. So 0 plus 1, 2, 3, and 4. Okay. Normally, what we do is firstly we put in initial investment. So rather, we can just call it investment because it's no longer initial. So investment in year 0. So we are doing like a half investment. So initially $500,000, and then later, after 1 year, it's not 250. It will be, I don't know, what did I do over here? Sorry, I've copied the formula. It should be same. Okay. $500,000. So initial investment in machinery or whatever. Then we have our sales. Okay, sales from first year onwards. They are already inflated, so it's very easy. Unlike Vixen company where we had to inflate. So this into this. We didn't take a break because there's shortage of time. Okay, so I want to complete the paper. Right? Now we can just drag and drop the formula. Okay, let's just adjust the cell width. Sorry. Oh, that's a big amount. Something seems off. Wait, I'll just have a look at it. These seems, I think I've done something wrong. Oh, sales revenue have already been given. I thought it was sales per unit. Yeah, sales revenue is just given. We just have to take it as is. Okay. Wait. So it's just equal to this, right? That's it. Why is this? I don't know why the sheet sometimes. So yeah, when you practice, you will understand sometimes it doesn't do instantaneously what we want it to do. Okay, so let me just bring these back. Okay, so year one sales, they were given as is. For variables, we will have to, so rather less variable cost is equal to, is it variable cost per unit? No, right? They variable, it's not variable cost per unit either. So then why have they given? I think maybe for fixed costs, anyways. So this again, it's dollar terms and it's a negative value. Okay, and then less fixed cost. What have we written for fixed cost? Fixed cost. Oh, we didn't write anything in our summary. I must have missed it. Fixed cost relating to project will be $10 per unit in the first year, and then it expects to we expect it to remain same, like per unit cost, but it will change. Oh, okay, and no inflation is expected. All right. So it is $10 a unit into number of units. Okay. So these are our fixed costs. Now again, fixed costs will be negative, as in it's an outflow. Since we have already written less, no need, but still just presenting it in this way. Okay. Or no need to write less. Just do. Otherwise, someone will do minus minus. Okay. So these are our cash flows. So our profits will be now. How do I say it? So investment is $500,000. We are not going to pay tax on it. So actually, it's always a good idea to do investments at the end. Okay, so we'll insert it somewhere here. Yeah, as a rule of thumb, okay, always do investments at the end, right? Because no tax will be on those investments. So now we can just find the sum of these. These are our profits. Okay. So profits, then we have tax on it. Tax is at 30%, right? So 43,050, so on and so forth. Now we will, since it's 1 year in arrear, we are going to shift it. So cut and then paste, Control X, Control V. This is year 5. Okay. So just say that this was one important figure that we found. Then add TAD. Okay. For that, we need to calculate tax allowable depreciation. Then this is actually investment in the machinery. And then we also have working capital investment. So we first put this up. Then working capital investment. Okay. I think these are all the figures. Nothing else has been given to us. Then we can find our cash flows. So firstly, let's find the TAD, tax allowable depreciation. Okay, so the price of the asset we know is $1 million. So say this is a working note. So working note 1, which is calculating tax savings on TAD. Right? So tax savings on TAD will be, so again, we'll do, so value of the machine is $1 million. Okay. Then we'll do a depreciation or TAD at, I think it was 25%. Then we have our WDV. Okay. So okay, so tax savings, this is $1 million. Tax savings on TAD. Okay, so on this we are saving 30% tax, then make it in a million form. All right, so we are saving 75,000 dollars. Okay, this is for year 1, and year of benefit. So this will be year 2 because the savings are as in TAD, as in taxes are 1 year in arrear. Okay, so 1, 2, 3, 4. Okay, so this is year 3. This is year 4 and year 5. However, year now, since it's the last year, we may not. Let's see if it's sold for a scrap value. I remember entering a scrap value. So actually, we should be adding that over here as well. So scrap after 4 years is 30,000. $30,000. So this is not. This will be scrap. Okay. So $30,000. So you can just write $30,000 divided by in a million terms. Okay. So $9,000 is what we can, no, not on this. We'll do it on the balancing figure. Okay. So whatever we did is for this. Sorry. Okay. So it's on the WDV. Wait a minute. WDV. Written down value, written down value, written down value. Okay, now this is balancing allowance. Okay. Over here, remember to shift it because this is not a depreciation. Okay, tax savings will be on the balancing allowance, and this will accrue in year 5. All right, so we'll just put those values down. So in year 2, we are going to get 75,000. Year 3, 56 to 50. Year 4, 42,118. Year 5, 117, 563. Okay, that's our tax savings. Then uh, investment in machinery, and then there is also scrap we can add. Okay, so scrap we can add at the very end. Scrap value was how much? $300,000. So have I written it? Yeah, sorry, $30,000. Good, I referred because otherwise I would have written 300,000. Okay, so scrap value would be $30,000. Working capital investment. Now the next working note. Okay, working capital. Sorry, working note 2. WC investment. Okay, so we have a table already. Now we know what the requirement is. So to be invested, right? So we'll invest this much. Now it will be whatever was invested and whatever your requirement, or rather requirement minus whatever was invested previously. Okay, or rather how much ever was pumped in previously. So 20, 30, 40, and then 110 full release. Okay, so $100,000 firstly invested. Right? Then in dollar terms. Okay, so we can find our total cash flows is equal to sum of this, add tax profits. Okay, so we arrived at all our relevant cash flows, right? And now we just have to do the NPV at 10% discounting. Okay, so is equal to NPV. Select the cash flow, that is, sorry, discounting rate 10%, and then select the undiscounted future cash flow. So future cash flows, not present. So from year 1 onwards, and then we need to adjust for year 0. Okay, so it's 303. Wait, sorry, this working capital investment is from year 1 onwards, right? So, oh no, year 0, this seems proper. Yeah, okay. Wait, there seems to be some mistake. Mm, Oh, we didn't take these two. Still there is, wait. Taxation was not, so this will be a minus because it's an outflow. We took a summation sign. Okay. So, yeah. NPV at a rate of 10%, which again from year one, two things we had not done. Okay. The initial investment. Sorry. Okay, 376. 30,000 outflow, 75,000 inflow added, tax 43,058, and profits of $128,000. Wait, just a moment. There's some error. I'm just trying to figure that out. Maybe there's some sign. Yeah, fixed costs. Okay. Fixed costs will be negative, which we did not take. Yeah. So fixed costs are negative 530, 530. I think I'll just recheck all the signs. Uh, sales are all our sales are inflows, so positives. Variable cost will be negatives. Then this is, yeah, fixed cost is, oh, wait a minute. There's something relating to fixed cost. Fixed cost relating to project will be $10 per unit in the first year. The fixed cost is expected to remain unchanged in price terms throughout the project and no inflation. Okay, so in price term, it's not from per unit terms. Okay, it's going to be this same. So that's one common mistake that the student would immediately, like how we did earlier, okay, would change the fixed cost also accordingly. However, they said explicitly it's to remain same. We missed that out. Okay, we thought that it is only $10 fix, but it will remain the same throughout. Okay, in price terms. So the price of the fixed cost is 350,000. So this question, or rather these quantities were given just to confuse us. Okay, so the fixed cost will be $350,000 only. And then we have our profits available, our taxes are in place, and then this is how our total cash flows will be. Okay. Uh, and when we find the NPV, we'll find out that the NPV is, wait, uh, 600, 376, 500, 404, 695, 129, 131, 858, 67, 907. Okay. Have we done the discount? Yeah, 10% discounting. Sorry, what was our discounting rate was 15%, not 10%. Should, I don't know, again, I missed writing it out. Cost of capital. Okay, what was this? Cost of capital after tax cost of capital was 15%. I don't know where I got 10% from. That's why that very important to write down that summary properly, which I did in a hurry because to save time. So wait, I'll just check everything. Minus fixed costs, profits, taxes are negative. TAD is added, investment in machinery is outflows, scrap values and inflow at the end taken. Yeah. So NPV at 15% is a negative 55,684. Okay. So we will say that we won't go ahead with the project. So our recommendation was given the above forecasts, the NPV is negative and thus we recommend not to invest in the project. Right? Just mention that. Okay. Now IRR of the project and comment upon your findings. So we now find the IRR of this project. Well, for IRR, it's very simple. This is part 2 of the question. Equal to, so firstly, IRR is equal to IRR of all the cash flows, 12%. Okay. So as simple as that, the IRR will be 12.1%. In fact, if you want to do a quick check, you can just modify this and see it is 0. Correct? Okay, so 12.1% is the IRR. We calculate our IRR with our this thing, what do you say? Cost of capital. Now, our IRR, that is our internal rate of return, is lesser than the cost of capital. So recommendation, given the above forecast, the IRR is less than the cost of capital or post-tax cost of or nominal post-tax cost of capital. So we will say given the above forecast, the IRR is less than nominal, therefore, or thus, we recommend not to invest in the project. Okay. So that's our let me just X wrap this. Not even no problem. Okay, with this, we are done with question 31. Now, we do not like we are almost reaching an end to our 3 hour session. I have another class after this. So what we'll do is we'll just read through. Okay, so the theory question of this we have already discussed. Okay. Ideally, we have 3 hours to attempt the paper. Here I have been explaining also and solving everything. Okay, so we are not left with much time. We are just left with 10-15 minutes. What I will do is um, I'll just read through this question, okay, and try solving it yourself. And if you have any doubts, you can always leave it in the comment section and we can get back to you over there. So this would be like a nice test for yourself. Okay. So so before, first thing we do is read the requirements, calculate the expected weighted average cost of capital for Fly High at 30 on 31st May 20x2. Okay. So we have to find WACC, which means cost of equity, cost of debt, and all of that. Explain the impact of the new bank loan on cost of equity and cost of debt and WACC. Okay. So this is like a theory question. So if bank loan goes up, then what impact would it have on cost of equity? Okay. Possibly, like, again, I haven't read the question, so I don't know whether it's numerical or a theory, but I'm assuming this is a theory question. Okay. So if debt increases, it makes the company a little more risky. Okay. So if the company becomes a little more risky, automatically cost of equity will go up, and cost of debt, now, depending on at what rate the loan is taken, will accordingly show a reflection of that. WACC, on the other hand, now they have said using the traditional model. The traditional model says that up to a certain level, the cheapness of debt is able to compensate for the rise in the cost of equity. But beyond a certain point, that means beyond a certain level of debt, then the cheapness of debt is not able to compensate. So initially, as you increase debt, WACC reduces. But after that certain point, that is your ideal or the minimum cost point, okay, then if you increase debt, the WACC is going to start increasing. Why? Because the expensiveness or the increase in the cost of equity cannot be compensated by the cheapness of debt. Okay, so we can write all of that over here. Explain why Fly High might decide to raise capital in form of convertible debt issue rather than straight equity or debt. Possibly, debt will be cheaper and would lead to lower WACCs, and therefore you would go for that. Also, debt. Why is it cheaper? Because tax shield is enjoyed. Plus, it's a fixed cost. Okay. So yeah, I think B and C are majorly theory with some obviously reference to the case. And here we have to calculate cost of capital, WACC. Okay, so individually calculate cost of equity, so it seems like a easy question. Let's read. FlyHigh operates a low-cost airline as listed and is a listed company. In comparison to its major competitors, it is relatively small, but it has expanded significantly in recent years. The shares are held mainly by large financial institutions. Now, since due to lack of time, I am not going to write a financial summary of it. You can write it. If need be, we'll just directly do the calculations over here only. Okay, without formatting or anything. Following are extracts from Fly High's budgeted statement of financial position. So, number of equity shares, as in equity, face value. So, this divided by 0.5 will give you number of equity shares. Reserves are available. Loan notes at nominal value is available. Loan notes at 9%. Dividend has grown in the past at 3%. So, dividend growth rate is 3% a year, resulting in an expected dividend of $1 per share to be declared and paid on 31st May 2020x2. Dividends are expected to grow at 4% a year from 1st June 2000x2 for the foreseeable future. So actually 3% is not our growth, 4% is our growth. Okay. The share price is currently 10.4x dividend, okay, which is not expected to change before 31st May. So our current X dividend share price is $10.4. How much is our dividend? Now our dividend is $1. Now, depending on what we are currently on 31st May. So as on 31st May, it was, so our D0 is $1. And then next year, so D1, when we want D1, it's going to grow at 4%. Okay, next year. In the past, it has grown. So this 3% is given as a confusion or to create confusion, this 3% has been given. It's in the past. In the future, we want cost of equity is okay. We'll just read, but with this information, we can easily find our cost of equity. All right. So KE is equal to, if you know, we do D1 divided by P0 P0 plus G. Okay. So cost of equity is equal to, now for D1, we already know that our current dividend is $1. So $1. Now we need to find D1. So $1 into, wait, let me just see if the screen is coming properly. Yeah. $1 into 1 plus growth. So 1 plus 4%. All right. So this is the numerator divided by price. Price is 10.4, already given us the ex-dividend share price, which is what we require. Okay, this is the whole thing, plus G being 4%. Okay, so 14% is cost of equity. All right, very simple. Now cost of debt. What else? The existing loan notes are due to be redeemed at par on 31st May 20x5. We are currently at 20x2. Okay. So if we had to say, let's do 2022. That's 1, 23, 24, 25. Okay. Redeemed at par. So redemption value is market value. The existing loan notes are due to be redeemed at par. The market value of these loan notes at 1st June 20x2 is expected to be 100.84 x interest per $100 nominal value. Interest is payable annually in arrears on 31st May and is allowable for tax purpose. Tax is payable on profit at a rate of 30%. Assume taxation is payable at the end of the year in which taxable profits arise. Okay, so here there is a small little trick they have used. Okay, if you see that interest is paid annually in arrears. All right, so normally we have been paying. So if instead of putting in years, if I had to put in, like, normally what we will do is year 0 is there. Okay, then year 1, 2, 3, 4 is what you will do. However, interests are paid in arrears. That means 1 year delay. Actually, I'll just show it to you without any delay, how we would normally do and how this thing kind of like changes. Okay, so in year 0, the investor would, or we would receive $100.84. Okay, so this is an inflow, right? Or if you are thinking from the investor's point of view, let's just write it this way. Okay, this is the market value, then interest, and we need post-tax interest. Okay, how much is the interest we are paying? Interest is on $100. So on $100, we are paying a coupon of 9%. Okay. However, post-tax, so 1 minus T is, where did I, 30%. Okay. So is equal to 9% into 100 into 1 minus 30%. Okay. So 6.3. So every year, $6.3 is paid out as interest. Now, redemption was at par, which is at $100. Okay. Then if you had to write the discounting factor, now discounting factor we don't know. We have to find that out. So we have to find the IRR of this. Okay, is equal to I. Okay, now before we do this, what is happening is now. So okay, I'll just show it to you. Is equal to IRR. Wait, first, so we need all the total cash flow. Okay. Yeah. Right. This is our total cash flows, and we will say that IRR. Sorry. So is equal to IRR bracket open or select all cash flows, and it's 6%, 6.1%. Okay, or 6.06%. Right. However, what is happening is all these things are happening 1 year in arrears. All right. So if we are to look at now calculate the WAC as on 31st May 22. So we are currently in 1st June 22. Wait, the existing loan, the market value, interest is payable in at 31st May 20x5. So redemption is done at 20. I'm just for easy calc or let me just write it as this. So in 20x5, the redemption is being made. Okay. Currently, is it the existing loan notes are due to be redeemed on par 31st May 20x5. That's the end. The market value of these loan notes as on 1st June 20x2. 2, 3, 4, and 5. Okay. So this is actually 20x6. All right. So this cash flow, which we first thought that, oh, it was to be received in year 4, since everything is happening at a delay. Okay. And like, so this actually is getting redeemed over year. Right. Wait. Yeah. 106. Right. So year 0, your market value will be as is. Then year 1, 2, and 3 is only what you are going to consider, because we want as on year 5. So we are not going to take. So first I showed you what we would normally do. Okay. But you would take your figure only till I. Okay. So this is till I. Okay. 5.99. That is almost 6%. That will be your rate. Okay, your IRR rate. So 6% you can call it. Okay, so cost of debt is 6%, the exact cost of debt. It's not 6.06. Over there also you could, but basically what is happening is you are, your 4 interest that you are paying are in a lag. Okay, so you are going to take only 3 years interest, 1, 2, 3. Okay, and do it accordingly. Clear? So keep this in mind. Okay, not 4 years. That was the only tricky bit. And now you can put in your WACC. Okay, now in order to do your to value the equity, value the debt, basically get the profit. Okay, so weight of equity, weight of debt. I think that part is easy. You would know how much debt and equity we have. Remember, it's on market value. Okay. Now, based on that weight, we'll do a weighted average and arrive at our answer. Okay. So I think, or okay, let's just quickly do it. We are a little over time, but let's just quickly do it. We didn't even take breaks. So value of equity, we know that there are 50 ordinary shares. So 50 divided by 0.5. Okay, so that's the number of shares. Okay, so if I have to say number of equity is equal to 50 divided by 0.5, right? That's 100 million shares. Okay, price per share, market value per share was the price per share $10.4. Okay, so total equity, so $1040 million. Okay, weight of debt. Now debt is 200 at nominal value, so 200. Okay, now what is the market value of debt? 100.84. Okay, so what we can do is, or we can just say the incremental, or if you want, we could do the same thing what we did for, so number of loan notes and market value per note. Okay, so it's basically 200 divided by, was it 200? Where is it? Yeah. Okay, so 2 million, and then market value was 100.84. So so $201.68 million. Okay. So weight of debt will be this divided by, and let me just put, okay, total capital employed will be debt plus equity, this plus this. Okay, that many $1 million. So weight of debt will be this divided by this. Okay, so 16%, and weight of equity will be this divided by this. That is the balance, 83.76. Now, what I can actually do is, okay, now cost of, let me just write it like this. Okay, weights cost of debt is 6%, equity is 14%, and this is cost of debt, okay? Post-tax cost of debt, right? Just highlight this. Okay. So WACC will be so my WACC is 13%, or if it's 1 decimal point, then it's 2.7%. Okay, so this is my WACC. Okay, so yeah, we took a little more time, but we solved the entire question. So 12.7% is the WACC. Ignore the formatting, didn't have time to format it, just quickly did it. So 12.7% is our WACC. Let's highlight this, and that's that. Okay, so we are done for the day. Tomorrow we'll similarly solve another mock, which is a pre-June paper. So we'll be doing that. Okay, thank you so much for your time. Go through this clearly, see the mistakes that I made in the paper. Okay, while solving, these are exactly the mistakes that you would typically make. All right, so learn from those mistakes and do not repeat them in the exam. All the very best. Take care.